Mihir, good afternoon. Thanks for taking the time out. Your quick view on how the benchmarks have behaved and performed right now. While some may argue that we are at expensive valuations, there is another pocket in the market which suggests that there's a lot more to come. Now, let's just stick with the Nifty 50 and perhaps the large cap stocks, because I want to take up the broader markets as well. But for now, what is your own assessment on the large cap valuations?
Hi. First of all, congratulations to all of us. Never complain when the markets are in a new high. So the point is that Nifty earnings this quarter have been muted, but that's at the aggregate level. In fact, even if you look at the broader market of 500 stocks, the earnings are like single digit compared to what they were, a few quarters ago. So obviously the margins tailwind is no longer there. And now we are back to normalized margins and normal growth. So if you look at the valuations of the large caps in aggregate, I would say they are a little expensive, but not really so expensive that one needs to be worried about. And there is enough scope for stock picking within the segments also. For example, financials is the largest segment, but within financials, the lenders have underperformed, banks and NBFCs for quite a few quarters. So there is pocket of value emerging in some quarters like that. Probably we can also say that some of the other segments like consumer discretionary, even some of the large cap names in cap goods and infra have not done as well as some of the mid and small caps. So there is relative value to be found in the market across market caps, I would say.
Sure, Mihir. So I was actually taking a look at the kind of returns that we've seen for the mid-cap and the small-cap indices advancing by around 28-29% year-to-date. In comparison, we've seen the Nifty advance by around 16-17%. So that's clear outperformance when it comes to the broader markets. Now, your assessment of whether or not there is froth in mid-caps and small-caps largely at the moment?
Certainly. So there is froth and there has always been froth, frankly speaking. And I would say that it's time to be a bit more choosy compared to before, and not really go down and compromise on the quality of the companies that you're investing in. So the rally is quite broad-based. As you rightly mentioned, the small caps, the micro caps are seeing a lot of retail action. And obviously when retail is there, not everybody is so discerning in terms of quality, unlike, say, the HNIs or the institutions, so to say. So I think as retail investors, one needs to be careful about really getting trapped into something that you regret later, so to say. But having said that, the economic activity recovery itself is quite broad-based. You are seeing nascent signs of rural consumption coming back. You are seeing some nascent signs of even the mid-cap and the private sector starting to invest in manufacturing capacity creation. So I think we are in for a decent cyclical run, and probably we are at the beginning of that run, and this can last for a while. So I would not be, too worried at the aggregate level, both in terms of growth prospects as well as valuations.
All right. Mihir, of course, to a certain extent, the extension in the market rally at the moment is a function of liquidity. Now, off late, what we are seeing is that FPIs have turned buyers. I know it's not a very not for a very long period, but domestic institutions, on the other hand, have continued to buy into Indian equities, and I suppose that that's largely because retail participation has had plenty of flows come through as well. At what point in time do you think that there could be a challenge when it comes to the liquidity at the moment, and any other factor that you could potentially see when it comes to which could pose a risk in the current environment?
So right now things look hunky-dory because we are talking about the Fed beginning to ease the cycle, touch interest rates as soon as next month. RBI probably will do it after 3 or 4 months after the Fed. So as far as the peak tightness or the peak interest rates are concerned, I think they are pretty much there. So things can only go better from here. There can be headwinds if there are commodity shocks like oil because of problems in the Middle East, or if the US really slows down much faster than expected, much worse than expected. Those could create headwinds to the overall growth story. The good side is that we are not that dependent on exports, though we should be exporting much more, but in general, we're going to trade deficit. So we should be relatively less impacted by a US dollar. But that is something definitely to keep in mind. There could be global headwinds.
And a final question then, Mihir, on how markets are being seen globally, how Indian markets are being seen globally. Now, there's a chance that the Federal Reserve could potentially cut rates or start the cycle of cutting rates this come September. What sort of an impact could it potentially have for emerging markets like India going forward?
So that could potentially have a positive impact. As I said, one is that liquidity conditions will ease. That's one good thing. Second is that the dollar strength will no longer be a concern. So typically, when the dollar strengthens, it tends to pull money away from all markets back to the US, and vice versa. When it gets cut, we should see the dollar weakening. In fact, in the last few days, we've already seen the DXY index, which is the dollar index against the basket of global currencies, already beginning to weaken. So that should ease the pressures on emerging markets, and if the dollar continues to weaken because of rate cuts, then you can actually see good flows to emerging markets restart. So I think that could have a positive impact on flows.
Okay, Mihir, we leave it at that. Thank you so much for joining us and taking some time out and talking to us on the occasion of Nifty making yet another new life high.